Hello everyone, good morning. Uh, from today, we will start our reading practice. So please join and give your suggestion after the video. So here is an article published in Economic Times. So we will start with that. So headline is IndusInd Bank's derivative portfolio under pressure. Is unwinding of yen carry trade the reason? So they are guessing what was the reason for loss in IndusInd Bank. So we will start. When IndusInd Bank reported discrepancies in its derivatives portfolio, where the bank will have to take hit of 2.35% of its net worth. The basic question was, how could this even happen? After all, the bank has been doing these trades for the last 8 years. What went wrong? The answer lies in a trade that has been existing for the last 2 decades, which has benefited from low interest rates. For the longest time, Japanese and Swedish interest rates have remained low, helping derivative labs across the world to create exotic products that would benefit on the simple underlying fact that interest rates in Japan and Switzerland do not change. But that has not been the case. In March 2024, the Bank of Japan ended its negative interest rate policy, adjusting to benchmark rate from minus 0.1% to range of 0 to 0.1%. In July 2024, the Bank of Japan further increased the policy rate to around 0.25%. This simple act ended the yen carry trade, which was around for 17 years. Okay, the trade allowed investors to borrow money at lower interest cost and use it to invest in asset or currencies that offer higher yields. The estimated size of the trade is around USD 350 billion in terms of loans by Japanese bank, but the actual size could be higher due to leverage used by long short funds. The trade has been directly responsible in creation of exotic derivatives, pricing of debt market, even valuation of equities. It has led to Japanese housewives to become as derivative traders and make money on every trade. Okay, so here is one graph they have given, percentage of change year and year. Okay, consumer prices chart. Okay, so Indian yen story. Indian banks have been huge beneficiaries of this trade where they have borrowed in low cost yen to hedge with NRI deposits. But while doing so, they have also got into trades that for the longest time have given them huge profits. But a little upward moment in Japanese interest rates have created big problem for this bank. IndusInd Bank used 3 to 5 year yen deposit as part of its internal trades where interest rates were very low. It was using the same to swap with 10-year US dollar borrowing. According to Motilal Oswal report, these trades were on swap contract and not on mark to market basis. But in April 2024, the bank had to discontinue its internal trades and follow RBI guidelines which were issued in September 2023 to align its books with the market prices. Experts say that the losses actually started to happen after the Bank of Japan increased interest rate for the first time in March 2024. Clearly, whoever created this instrument had a hardline belief that no matter what happens, there is no way that Japanese interest rates will go up and disrupt banks' income profile. The estimate impact of losses works out to 2.35% of net worth, or Indian rupees 2100 crore CR. Now RBI wants to do an audit and find out if there are other banks that used yen dollar swap in their derivative trading. The background: this is not the first time that derivatives have blown up due to a minor increase in interest rate. In 2006 and 7, Swiss francs was considered to be ultimate stable currency where interest rate had not moved, and many exotic derivatives were created with the Swiss francs as the base currency. The Swiss National Bank has raised policy rates in 5 quarterly steps to 25 BP each, to basis point, that means to 2.25% by March 2007. In the March policy statement, the SNB leaned toward continuing lifting interest rate, partly based on high level of capacity utilization and weak exchange rate, but noted the need to remain flexible. Market participants on average price in a slight rate increase for June 2007. It was a time when many Indian companies announced to the stock exchange that they were sitting on notional losses because of their exposure to foreign exchange derivatives. Amtex Auto announced that the company was sitting on Indian rupees 72 crore loss, which announced to 30% net profit INR to 36 crore during the year ended May 2007. Interestingly, the company had earned INR 36 crore in terms of forex revenue on account of derivative profits in the previous year. According to Rediff, a new website software company, Hexaware, declared that it had made an INR 80 crore loss for the quarter ended December 2007, and the company had taken a huge hit of INR 103 crore on account of forex derivatives that went bust. Similar has been the case with Sundaram Multipap, which had actually sued ICICI Bank for its losses on forex derivatives, which the company said was sold to them by the bank. It was not that these banks were creating these derivatives in the Indian market. They were mostly third party products that the bank was using to sell it to exporters who wanted to hedge their currency risk, and at the same time which could lead to additional fee income. The banks were hedging their forex deposits separately. The Indian banks had assumed that the Swiss francs will never move, and there were no signal in the Swiss economy to show that the SNB will actually raise interest rate. But that is the beauty of pricing financial product. They are based on fundamental assumptions that all things being equal, the derivative product should ideally give a high return with almost no risk. But interest rates, which have a huge bearing on currencies, have a way of moving up. Very few investors rate are in a position to understand that which is stable can turn volatile without any prior warning. The smartest person in the room, as usual, turned out to be Warren Buffett, who issued low cost yen denomination bond to fund his acquisition of 5 Japanese companies. In 2024, the yen had appreciated 11% against the dollar, and this helped Berkshire Hathaway to report US dollar 850 million in after tax gains in its Japanese bonds. This is despite the rise in interest rate. Why did the interest rate in Japan rise? In a speech on March 5, 2025, Uchinda Shichindi, Deputy Governor of the Bank of Japan, acknowledged the volatility in exchange rate and stock prices resulting from yen carry trade unwind. The unwinding of this yen carry position when the bank raised its policy interest rate in 2024 was one of the factors behind the large fluctuation in exchange rate and stock prices. Chindi. This carry trade market is estimated to be around US dollar 4 trillion. After the 1990s, Japan got mired into a vicious cycle of stagnation and deflection, crashing its share in world stock market capitalization of 6% in 2023, a mighty fall from its peak of 45% in December 1989. It wasn't until the then Prime Minister Shinzo Abe's expansionary fiscal policies in 2013, better known as the Abenomics program, that Japan managed to battle deflation and started gradual recovery. Things changed markedly in recent years as growth come back accompanied with inflation. Market participants expect the Bank of Japan policy rate to raise to 1% over the next 18 months from 0.58%. Rising rates in Japan combined with a falling dollar are leading the yen to appreciate. Since the start of this year, the dollar index has fallen nearly 6%, whereas the Japanese yen has strengthened around 6.3% against the US dollar during the same period. There are expectations that rates will turn lower going ahead in the US, whereas they will go up in Japan. This means persistent challenge of higher rates and yen appreciation will continue to create dislocations in the market. A carry trade that made sense at zero rate may not be viable when rates are positive and host currency is rising. Pressure from US President Donald Trump also be the factor behind yen's recent strength as he has accused China and Japan of keeping their currencies depressed. I have called presidency, I have called the leader of Japan to say you can't continue to reduce and break down your currency. Trump said at the White House on March 4. You can't do it because it's unfair to us. It's very hard for us to make tractors, caterpillars here even when Japan, China, other places are killing their currency, meaning driving it down, he said. Responding to Trump's comment the following day, Japanese Finance Minister Kutsu Abe said Tokyo was not taking policies directly aimed at weakening the yen as per a Reuters report. Rising rates are geopolitical factor alongside a falling dollar means investor yen may continue to rise going ahead. The final cut on the face, it might appear that the Japanese interest rate has moved from 0.1% to 0.5, which appears to be very low when compared to the US interest rate at 4.2. But it simply means that those who have borrowed in yen will now have to churn out 5 times more in terms of cost and the yield are lower. Now RBI want to investigate other banks to see if they have traded into similar kind of derivatives which involved yen transaction, but the stock market is resilient. Since Feb 27, 2025, the IndusInd Bank is down by 35% and trades in INR 676. The Nifty Bank Index is down 2% for the same period. In general, there is a feeling that this is more of IndusInd Bank related issue, while other banks do not have such kind of unhedged derivative position on their sheet. So this article is completed. So what I understand, because of the increased Japanese rate, the yen trade derivative they made loss. This is the reason IndusInd Bank prices fall in the stock market. So this is how geopolitical news or factor affect the our local stock market or price of the particular stock. So that is the reason we have to update our information about our day to our stock which is in our portfolio. Thank you. Have a nice day.